Will investing in the ICICI Prudential Future Perfect Plan help you in achieving your financial goals in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. So this is a non-linked endowment life insurance savings plan. Some of the key features of the policy are: this is an endowment plan and you will get guaranteed benefits such as guaranteed maturity benefit and guaranteed additions each year based on your policy term. And you may also receive non-guaranteed bonuses such as reversionary or terminal bonuses. And in case of death of a policyholder, death benefit will also be provided. So this plan offers two guaranteed benefits. One is guaranteed maturity benefit, which is GMB, which is a fixed amount that depends on your various things like age, policy term, premium payment term, and gender. So GMB gets activated as soon as you purchase this policy, and you will receive the guaranteed amount from this benefit as soon as your policy matures. For example, if your policy term is 20 years, you will receive the GMB in the 20th year. So these benefits are payable subjected to payment of all your due premiums. Another guaranteed benefit is the guaranteed addition benefit. So these are added to your maturity amount for every policy year that you stay invested in. So how much percentage that will be added back to your policy will depend on your policy year and your policy term. So the longer you stay invested, you will receive higher guaranteed returns on maturity. For example, if you choose a premium payment term of more than 10 years and stay invested for more than 16 years, you will get the maximum guaranteed additions of 18%. And in this policy, the bonuses are non-guaranteed. So it offers two types of bonuses. One is reversionary bonus. So this is declared every year as a percentage of your guaranteed maturity benefit, and yearly reversionary bonus if you had any. So the exact calculation of this is unclear, but it can be calculated using the online calculator available on the ICICI website. So this bonus is payable at maturity of the policy, or it is payable along with death benefits. So reversionary bonus in cash advantage is added every year to your maturity benefits. Now we have another type of bonus, which is the terminal bonus. So this is a one-time bonus declared at the time of maturity for participating policy. Though they are a non-guaranteed bonus, still its value depends on the duration of how long you stay invested in this policy. But there is no clear-cut way to find terminal bonuses, but you can still use the online calculator available on the ICICI's website to get the rough estimates. So now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to calculate the internal rate of return IRR, just to see how much actual returns we get in our hands by investing in this policy and whether it will be sustainable. And we will also do an analysis on the benefits we will receive in this policy. For calculation purpose, let us assume the policy holder is 30 years old and he chooses to invest in this policy with the premium amount of 1 lakh per annum. So he has opted for a payment duration as 10 years and he has fixed his policy term as 20 years. So if you invest the premium of 1 lakh rupees per annum with taxes, you would have to pay total yearly premium of 1,04,501 rupees for the first year and 1,02,251 rupees for subsequent years. So at maturity, you will get 25,70,254 rupees, which consist of guaranteed benefits and estimated bonuses of 13,84,426 rupees at 8% rate of return. So this is for the best case scenario we are calculating. Or you will get 15,53,975 rupees, which consist of guaranteed benefits and estimated bonuses of 3,68,147 rupees at 4% rate of return. So this indicates the worst case scenario. Please note that these estimated bonuses are not guaranteed. That's why we are giving you two scenarios, a best case scenario and a worst case scenario. So the assured sum assured in this policy is 10 lakhs. So it is the amount of life insurance cover paid to the nominee in case of, unfortunately, the policyholder's death. Now let's take a closer look at the guaranteed benefits and estimated bonuses. So as you can notice, the total guaranteed benefits are 11,85,828 rupees. So it consists of guaranteed maturity benefit and guaranteed additions on maturity. So guaranteed maturity benefits are set at the inception of the policy. So its value depends on the policyholder's age, policy term, premium payment term and gender. They are guaranteed, but how the sum is actually fixed is unknown. And guaranteed additions, as we have already discussed earlier, they are added to your maturity amount for every policy year that you stay invested according to the rate of interest per annum as described in the previous section. So you're paying 1 lakh per annum for 10 years exclusive of GST, and you're receiving the guaranteed benefits of 11,85,828 rupees. So it shows that only the principal you paid is guaranteed, which means it does not contain any returns. So in the best case scenario, your IRR is 6.18%, and in the worst case scenario, it's 2.86%. So in the policy term of 20 long years, on average, you can expect your returns to be somewhere between 3 to 6.2% in this policy. Now, do you think it is good enough return for a 20-year long-term investment term? Do you think at this rate, will it be able to achieve an inflation-beating return? Definitely not. Though this policy uses catchy words such as guaranteed benefits or future perfect, in reality it is not true. So let's have a look at its biggest disadvantage. As you might have noticed in the example tabular column, that in the best case scenario you are getting the maximum returns of merely 6.18%. So therefore you are receiving 11,85,828 rupees plus the non-guaranteed estimated bonus of 13,84,426 rupees. Anyways, in the best case scenario, you will receive the sum of above, that is 25,70,254 rupees on maturity, which means after 20 years. But is it a good deal? Let's say if you invest in PPF or mutual fund instead. In this alternative strategy, you can actually accumulate a higher corpus by effectively allocating to insurance and investments separately. So for life coverage, we have opted for a pure term life insurance policy with a sum assured of 10 lakh, which only cost us a premium of 6,600 rupees annually. So the policy term and the premium term mirrors the ICICI policy for a fair comparison. So this allows you to save 93,400 rupees out of the 1 lakh annual budget we had for ICICI premiums. So this can be adjusted for investing in corpus accumulation in a different investment vehicle. So here we have considered two investment instruments, one for equity, one for debt, just to see how different asset classes perform. So you can choose investments based on your risk appetite. This is just to give you an example. So in debt instrument case scenario, the PPF account requires a minimum contribution of 500 rupees per year for 15 years. So given the policy term is only 10 years, adjustments are made for the contributions in the remaining years. The final maturity value in the PPF account is 27.56 lakhs with an IRR of 6.64% when combined with the pure term policy. So in equity instrument scenario, ELSS, the pre-tax final maturity value of the ELSS fund is 57.01 lakhs. So after accounting for capital gains tax, the post-tax maturity value is 51.21 lakhs with an IRR of 10.81%, which is a post-tax return when combined with the pure term policy. So the accumulated corpus from these investments can help you achieve your life goals. So because these investments offer better returns, making them superior to the ICICI Pru Perfect Future plan. So what is the final verdict? Is investing in this policy worth or not? As you might have noticed, the claim of the company of making your future perfect is not so perfect. Instead, it is making your future tense by providing you the returns less than the average rate of inflation of 8%. In fact, you're losing your money through this policy. So, our advice is you should avoid investing in this policy. RDs can actually offer you the guaranteed return greater than 7% in the much shorter term. Or you can invest in PPF, which offers you a guaranteed return of 7.1%. And if you can tolerate the risk, then we suggest you to invest in equity mutual funds where you can get 12% returns on average if you choose to invest in for a longer period of time. But do not invest in this policy. Avoid it because it is not going to give you any kind of returns or any value to your portfolio.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.